Robinhood reported earnings on Wednesday and the stock jumped by 15%, taking the market cap to $11.9 billion. With $4.8 billion of corporate cash on the balance sheet and no debt, the enterprise value is $7 billion. This was an impressive quarter from Robinhood. Total revenues increased 24% to $471 million. Net income was positive and operating expenses declined 17%. Robinhood's promotions, such as retirement matching, are clearly gaining traction. 100,000 new retirement accounts were added in the fourth quarter, and this helped contribute to a 65% increase in assets under custody, which is the total value of assets held by Robinhood. The company said on the conference call that it's taking share from all of the major US brokerages, and with $103 billion of assets under custody, there's plenty of market share to be had. Schwab, by comparison, is at $9 trillion and Fidelity is at $13 trillion. Meanwhile, Robinhood continues to invest in growth. The company is improving its web offering, moving into the UK, building a credit card business, and its subscription service, Robinhood Gold, grew 25%. Zooming out, the company has now reported $1.9 billion of revenue over the last 12 months and $536 million of adjusted EBITDA. But full-year net income is still sharply negative, owing to a large chunk of stock-based compensation. Even so, at 13 times EBITDA, the stock has plenty of room for upside. That said, Robinhood's impressive growth owes a lot to higher interest rates. Net interest revenue has soared and at $929 million now makes up 50% of total revenue. The problem is that the Federal Reserve is finished raising rates, and its dot plot suggests rates could fall to 3% by 2026, which would hurt this revenue stream. Meanwhile, Robinhood's rivals are unlikely to just sit back and watch the company take market share. Let's assume Robinhood can grow transaction-based revenue at 5% per year for the next 3 years while growing its other revenues by 20% per year, and let's assume lower interest rates drop net interest revenue by 20%. In that scenario, Robinhood would be making $1.9 billion of revenue in 3 years' time, which is roughly the same as it is now. Overall, Robinhood's recent growth is encouraging, which makes the stock a tempting buy, but lower interest rates will act as a headwind to the company's growth. As a result, I give this stock a neutral rating, but these are my personal opinions, not financial advice, and I hold no position in Robinhood. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.